2, 1. There we go. Yes. How you doing, friends? It is Sunday, January 16th, and this is the retrospective for the previous week. Not a hugely down week, although the 3 alerted trades were all losers. And then the very last trade that I put on, that I failed to put in the suggested, but I did put in the filled trades, the SPX trade, was actually a very nice winner. In fact, it came very close to pinning. So that made up easily for the losses in the week. Now, I know that some people did not take that trade. So, I guess that's the way it goes. I'm making every effort that I can to try to be as consistent as I can in terms of putting the trades in the suggested, the alerts, and the fills, the analysis, all of that. Trying to improve every week, doing the best I can. So last week, and actually the last 2 weeks, have been particularly tough in this market. And it's not because we were doing anything wrong. In fact, if you look back at the analysis and then the trades that were put on, every single day, the trades or the analysis was spot on. The trades were good for a while, and then they weren't, which is incredibly frustrating. And what I mean by they were good for a while, then they weren't, was that price moved in those directions. And in many cases, even though the volatility was relatively elevated, the P&L lines became like suppressed and during the day, and not until the very end of the day, after price had moved away from the strategy, did they start to fill up the profit tent. I don't have a real answer for that or why that happens, but in the past, those all would have been profitable trades. And the market is very strange. It will, it basically will do whatever the hell it wants. It'll stay irrational, as they say. The market will stay irrational longer than you can stay solvent. And this is the principal reason why we trade very small. And so over the past 2 weeks, even though there were, I guess you could say 6 losers, 1 no trade. So 5 losers, 1 winner. And that 1 winner made up at least for 1 week. You should not have, if you were trading the size that I recommend, this should not have been a big loss. For me, personally, in my account, in the small account, it was about a 5 to 8% drawdown on an $8,000 account, which is, that's fairly significant, but it's not huge. On my big account, we're only talking about a 1.8, 1.9% drawdown. So maybe a 2%, excuse me, maybe a 2% at tops. Now that's pretty significant, but it's a huge account. And a lot of times that big account will fluctuate that much in a day anyways. So overall, if you were following the guidelines that I put out there for position size, this drawdown should not be a tremendous burden. Now, I know that a lot of you do not do that, and that some of you will cherry pick trades, the ones that you think are going to win, or you'll exit early or exit late, or oversize your positions, or whatever that is. And look, I completely understand how you get into that. Because I used to be there myself. The whole purpose of this service is to try to guide you and help you develop strategies and your own personal guidelines so that those things don't happen. The purpose of this whole strategy is to completely reduce and almost eliminate, not eliminate, but reduce account volatility. With a smaller account, that's very difficult to do because of the relative size of the smallest position compared to a small account size. But as you get into bigger accounts, there's no reason why you should ever have more than say a 7 or 8% drawdown throughout an entire year. And if you do, then you're just doing something wrong. And the thing that you're doing wrong is one of those things that I'm talking about. Now, I've been there. Look, I've run hedge funds where we've had 50% drawdowns, and we've made it back, but, it was a hedge fund. This is not a hedge fund. The purpose of this strategy is growth. It's not income. You cannot expect to make every single week, every single day a winning trade. What I expect is that every month is a winner. It's possible that we could have a losing month, but so far, at least what I've done so far, we have not had a losing month. December was in the middle part was actually a very good month. At the end, it sucked. In the beginning and middle, it was pretty good. November was a fantastic month. October was one of those months that was probably even, maybe a little bit above even. It wasn't definitely not a loser. It was big in the beginning and then shitty in the middle and end. September, August, July, June, May, April were all fantastic months. So for me anyways, it has been a nice curve, and that's, and that shows in some of the alerts. But for a lot of people, learning the strategy, it's takes a little time to work into it. This past couple of weeks have been particularly trying because, like I said, the market is unusual. As I said, any of these positions in the past would have been winning positions. Analysis was literally spot on. The arrows that I drew, where I expected price to go, was absolutely spot on. So that's extremely frustrating. So all I can say is that just keep on going forward and keep on doing the same thing. There's very slight adjustments that I would make to the strategy. Now, one of them is, and maybe going back to something that I started with at the very beginning, when I started this service. When I first started this service, I was doing iron flies. And an iron fly is basically an iron condor where the two short strikes are the same. And you use both puts and calls, right? You do a put credit spread and a call credit spread. And about a month or two into the service, I thought that might be a little bit complex for some people. That let's go to something simpler, just the simple butterfly. And then we could do broken wing butterflies. We could do unbalanced butterflies that added a little bit more complexity. But it was still simpler because the strategy was either all puts or all calls. And then we separated, whether they were puts or calls, depending on whether it was a bullish or a bearish trade. So bullish trades, we did an all call butterfly. Bearish trades, we did all put butterflies. And so those worked fantastic too. Up until, the end of this year, where nothing seemed to work. And so part of the problem that I saw was that we were missing on just a few strikes. And so I thought maybe going back to the iron fly would make some sense so that we can get a little bit more probabilistic And so what that means is that we can take the apex of the butterfly, this thing here, and then just spread it out a little bit. And that's what I did on Friday. I spread it out just a little bit, and it worked out fantastic. If I had not done that, it would have potentially been, a no-winner or close to a no-winner. So that worked. Again, the analysis was spot on where I thought price was going to go, et cetera. So that's not the problem. The volume profile and volumetric analysis is great. Works like a charm. Helps us decide where price is likely to go and where support and resistance are likely to be, and then we can just place trades so that it will capture those types of moves. For us, the problem has been this sort of volatility crush that happens during the day, forcing us to stay in trades much longer than we want to, and then by the time the volatility or the theta or premium collection starts taking over, the price starts moving away from the strategy, and we're sitting there without being able to take the benefit of what should have been a profitable day. And so that's been extremely frustrating. I don't know how you fix that, quite frankly. That's just an anomaly, or as they say, an irrational market, an irrationality that happens in the market. And no answer for it. There are some slight things that we can do. Like I said, by moving to the iron butterfly, I believe that will expand things. All right. So here I am, partway into this conversation and basically doing a review of what we saw this last week and the past couple of weeks and what I saw happen. So when you look at the strategy, in these retrospectives, I want to look at the strategy and say, what did we do right? What did we do wrong? What can we bring forward in the coming weeks? Will things be different? Now, I don't know if things will be different, but there are some things that we can do. Excuse me. I've got a little acid reflux here, so it's bothering me a bit. So the analysis is fine. Becoming an analytical person using volume profile, in my view, gives you the best possible chance for success. The placement of the strategies, I think, has been mostly good, except that the trades and the market hasn't been behaving the way we expected it to behave. So one thing that we can do to fix that a bit is put less risk on the front end and increase the probability of profit using a iron fly instead of just a straight butterfly. So that's one of the ideas. And so, but with this trade coming up on Tuesday, it's a different situation, and I don't see that as necessary for this. But that's in general what I plan on doing going forward, is making use of an iron butterfly a little bit more than just the butterfly, so that I can spread the two short strikes out by one, maybe two strikes, to increase the probability of profit. And so how that will help is in those situations where price has moved into our target area and then moved away a bit, by increasing that width a little bit at the top where we're getting the premium collection, that should help keep us more in the profitable zone longer. So that's the slight change that I would make. And that will really depend upon the analysis and where we think price is going to go. But let me review. I don't know if you've had a chance to see the analysis that I put up this morning in the Discord. But but I'll talk about that a little bit. And the way I'm going to talk about it is I'm going to do a little bit of diagramming here. And so we're going to go to the iPad. Onto the iPad. All right. But before we do that, let's take a look at the chart. Let's take a look at the chart so we can see the analysis here. So here's our market structure. And we have this very weak T1 node that we bounced off of and came through and then moved up through this volume well 2. And here, let me get to this here. Yeah. And moved up to volume well 2 with a very strong candle on Friday, but we came short of T0. Now, the trade that we had on Friday was predicated on us finding resistance here at this line, which was the one of the low points of that volume well. And it had been an area where we had found resistance before. So I placed the trade, the SPX trade, so that it would take advantage of that. And I made the short strikes wide so it straddled that line being at 46.50. I think it was at 46.53 when I put it on there, and for the ES, and 46.62 for the SPX. And I believe that the SPX closed at 46.62.85. So in fact, that analysis was only 85 cents off of what the actual ending trade was. So that analysis was spot on. And so that trade worked out really well. Now, if we go to a daily chart, we're going to see something quite a bit different here. Let me see if I can put all this into perspective here. All right, so here's a daily chart. And you can't see it, but there's a candle right here. And the reason why you can't see it is that it's all tail. It's all tail and just a tiny, tiny little body. It's the smallest doji you've ever seen. It's so small you can't even see the body of this candle, which is sitting right there. And it went through this little line here that I drew, the bottom of the volume well, and it ended up just slightly above it. Now, if you look at Monday had, and so essentially it created like a hammer, a huge long tail hammer, just like Monday. See, Monday had a big long tail hammer too, right here. And then that followed up with a big green candle that went through T0. It first went down and tested T1, and then came back up, and then had a huge reversal day. I think this was a V bottom, as a matter of fact. And then had a huge reversal day, went all the way through T0. And that's the day where I had put on 2 way out of the money bullish trades, and it went through both of them, which is, again, another like insane move. That was a 3 standard deviation move. But anyways, that's what followed up this big hammer. And now we have this other hammer that's set even higher. And I think that we're going to get a move up through T0 and potentially into the volume well 1, and could in fact even test the bottom of that volume well way up here at 47.48. That's a huge move. And I think that that's possible early on, and then I think it's also possible that we reverse. So I think that's going to happen early on. And if you look at the economic reports, there's really nothing happening on Tuesday. By the way, this is all for Tuesday. The market is going to open up tonight at 6 p.m. There's going to be very little volume. You're going to have a European market open. It's going to stay open until tomorrow, I think until either 11 or 1. I'm not sure about tomorrow, but it will close and then it will reopen. I'm talking about the futures market again tomorrow at 6 p.m. And that will actually be the start of the Tuesday session on Monday, right? And then there aren't any economic reports tomorrow. There's nothing of significance on Tuesday. The only thing that we have coming up is the Empire States Manufacturing Index at 8:30 on Tuesday morning. And that is a fairly impactful. It's not a hugely strong, impactful economic report. So we're going to be open for one day with virtually no volume and another day with hardly anything going on. And I expect that that's going to provide an environment to allow the market to continue this push up, especially after this huge reversal that we had on Friday. Huge reversal. So that's why I think we're going to get an early move up through T0 and into the volume well. And you know that once we get into a volume well, price acts one of two ways. It either scoots all the way through the volume well to the next node, which would be T1A, way up here. That would be an unbelievable move, quite frankly, starting from here all the way up there. That, you know, you're talking about an easily a 3 standard deviation move. But I think what's more likely to happen is that we're going to enter the volume well. Instead of scooting all the way across, we're going to get rejected. In either case, we have to account for both cases. And I want to account for both cases because I don't know which is going to happen. So in that, I want to put on a strategy that will take advantage of both of those cases. And I think I can actually show you that right here by changing the chart. Let's see if I can do that quickly here. We'll change it to there we go. So here's the strategy that I'm thinking of putting on. This is a modified butterfly to turn it into an unbalanced butterfly, but a little bit different than any other unbalanced butterfly that I've put on. Now, the way this would work, it looks just like an unbalanced butterfly, but you see this, there's an extra long leg at the back end that would protect against any kind of overshoot of the fly, and in fact would result in a potentially huge upside move. So basically this is a 1-2-2 butterfly. 1 long, 2 shorts, 2 longs. And so this butterfly, now the way this would work, and what I'm anticipating happening is that we'll move strongly into the volume well, and we'll get this upward leaning profit curve. As you can see, it goes almost straight up, and then pull back into the profit tent. And so I think that will give us a great opportunity to take profit. On the converse, if it doesn't do any of that, the risk on this side is relatively low. All right? So huge upside potential, low risk on if it doesn't do anything of what I'm talking about. And we'll get a good feel for this as time goes on. So that is that's the idea here. So that's what we're looking to do for Monday's trade. And we can actually put this trade on tonight, Sunday night, because it's a futures trade. There's a possibility that I don't know if the index will be open. I don't know if you can actually trade this in the morning on Monday as well. But it's for a Tuesday expiration. All right. All right. So let's go back to the big head here, and I don't know if anybody has any questions on that. That's but that's the trade that I'm envisioning for Monday. And what I'm going to do is I'll sort of illustrate that a little bit, and I want to illustrate something else too. there was one other thing that I wanted to illustrate, and that is another thing that we can do going forward, and that is to create some trades that are slightly longer term, that are also premium collection, but they bring in kind of an aspect of buffering any losses by creating a longer term trade that collects credit. And let me show you what that looks like. So this trade is for the end of next week. This trade is for the end of the next week. So it's and it's way out of the money. All right, so you can see the date up here is July 19th. Let's see, it actually goes even further than that. Let's see, 16 is today, 17 is Monday. So this actually should be even further out. This would be way out here. Let's see, what is Friday? Friday is the 21st. Okay. So this is a trade that I had conjured up, and as you can see, it has a credit. Now, right now the profit line is kind of suppressed. That's because the market isn't open. When the market opens, this will move further up. But in any event, right here is where price currently is, and for the entire week, you're going to see that this purple line is going to start rising into the profit tent. And so that will give us the opportunity to take a profit at any time between Tuesday and Friday while price is moving up. Now, do I expect it to move all the way up here? It's possible. If it did, and it moved all the way up here, we would be near an all-time high next week. And that is also possible. So anyways, this is a type of a trade that is an iron butterfly, and we can increase the size of the profit tent by widening the strikes on the short strikes up top here. But you can see that the key part of this is having a credit for a long period of time and being able to take this trade off at any time during there and, you know, make couple hundred bucks with relatively little risk. And if it moves all the way up here, potentially making a lot more than that. So that's a trade that I'm considering to help buffer our weekly trades. You know, very high probability, very far out of the money, long tail risk, and short tail collecting credit. All right. So that's an idea that I'm going to introduce into the service this month. All right, we have a question. JB says, is there any benefit to putting the trade on tonight instead of on Tuesday morning? The biggest benefit is that you'll have more premium, and so you'll be able to get a better price. January, not July. What does that mean? I'm not sure what that means. Another question. Everything else makes sense. Okay, cool. All right, back to the big head. So, so those are the things that I think that will improve, I think, our probability of profit. We'll put on these longer term trades to kind of buffer any kind of loss. We'll add the iron fly to increase the probability of profit, not on all trades, but on some trades. And on most trades, we will we'll set up the trade so that there's a smaller risk up front, and but essentially still do the same thing, because I think all of this is going to turn around and it's going to revert back to the way it was all last year at some point. I find that these past 2 weeks, even though they're concentrated, are very, very unusual. These last 2 weeks are outliers, quite frankly. So I've been doing this service now, and I've been actually doing this trade now for about a year and a half. And these 2 weeks are really the worst 2 weeks that I have traded in a year and a half. And they're still not that bad. I mean, only a winner 1 out of 5 trades is not great. But when your risk to reward is like 1 to 5 or 1 to 10, it's not bad either. And if it only results in a 5 or 7% drawdown in a tiny account and a 2% drawdown in a huge account, again, that's not bad at all. So I mean, those are the kind of odds that I can live with. The rest of the time has been off the hook. I mean, the small reference account has more than doubled in size in 9 months. So I don't know what to say about that. And my big account has improved dramatically. I mean, and I really haven't been trading it that much, but I've increased it by 20% at least, and that's only trading it part time. So overall, I think the strategy is sound. It's having to deal with things that are so unusual. And quite frankly, when we had things really cooking in the summer and in the late summer, it seemed like you couldn't lose. I think people get spoiled too. And now the new people that are coming on now, I think, are hardened. So people coming in at different times are going to experience very, very different things going into the service. Now, also keep in mind that this is not, and I keep on saying this is not an alert service. My goal here is to teach you how to trade and how to embody these philosophies of asymmetry and selling premium and anti-fragile nature of these strategies. That is the number one goal, and to teach you good trading habits. And through that asymmetry, take all the anxiety out of trading so that you can make clear choices. That is my number one goal here. It's an effective strategy, there's no doubt. It's had maybe 3, maybe 4 weeks out of 60 weeks. So it's had maybe 4 weak weeks out of 60 strong weeks. So from that point of view, the strategy is fantastic, in my view. It's just a matter of how you get through those times. And the way you get through them is by not veering off the strategy. In other words, don't cherry pick your trades. Don't add more to a trade because you think it's going to profit you more. Stay small all the time. All right? I mean, those are the keys. If you do that, downturns like right now or the middle 2 weeks of October will never hurt you. They won't hurt at all. And then you'll be able to take advantage of those good times, and they will elevate you and keep you growing your account. All right, let's see, more questions here. Peter says, how would you set up the longer term trade, Ernie? What does it look like? Well, the longer term trade is simply it's a iron fly, but it's like a broken wing butterfly. So it just has uneven legs. It puts it way out of the money in such a way that the near term or the near strike or the near put spread has a credit, and then the call spread has a debit. So, and it's way out of the money, so you make money during that week. And so you could go 2-3 days without ever challenging the far side risk. And the idea is that you will gain some profit during there. It may not be a lot of profit. It might be like, maybe $100 or so, but that's still something. That if you're constantly adding a little bit of cash to your overall account, that takes some of the sting out of those days where you have a down day, where it might cost you $100 to get into a trade. You got this trade, you can take it off, and it covers that one. So that's the idea behind putting this longer term trade on. And, you know, I'm going to look at putting it on this week. And if that works, then we'll put it on next week and then see if it's a weekly thing. And then trade also the individual days. Now, I did something like this the beginning of December and actually worked out quite well. And some people made it ended up that trade ended up making like, I think something ridiculous, like 1,200%. But some people took the trade off early and made, 100% of their risk, even though the trade was on for a while. It was on for almost a month. And it was truly a longer term trade, but I don't think it has to be on that long. I think 1 or 2 weeks you can put these longer term I call them account buffer trades. Let's see. The expiration date on that. Like I said, it could be 1 week, 2 weeks out, 3 weeks out, whatever seems to make sense. Is it harder to get filled with the iron fly that has one of the spreads deep in the money? No, as a matter of fact, if you wanted to, the iron fly would be easier to put on as 2 separate spreads if you wanted to. And putting on a spread is certainly easier to put on than putting on a, all 4 strikes at once. So that's one possibility you can do. You can put it on as an iron fly and, just wait for your price. It shouldn't be that hard to fill. You got to remember, we're dealing with the E-mini futures or the SPX. These are the most highly liquid assets that are out there. You should never really have that much of a problem for putting these things on, even if they are way out of the money. And just be patient. Are you still going to talk about adjusting the weak side of the iron fly? Yeah, in a second. Will the iron flies still have the 5-to-1 minimum? Yes, or 1-to-5. Reward to risk. Yes. So yes, I'm still maintaining the 1-to-5. I would prefer, in most cases, 1-to-10 or better. The 1-to-5 is a minimum. If I can't get 1-to-5, I won't take the trade. As a matter of fact, there have been several times where we haven't taken trades because I couldn't get 1-to-5. Can we do a butterfly with a spread in the short strikes so to increase the probability of profit? Well, that's what the iron butterfly is, where we have a spread in the short strikes. So the 2 short strikes are spread. As a matter of fact, that's what Friday's trade was. The short strikes were spread by 10 points. Mike is asking, given these big swing days, would it make sense to leg into the butterflies and iron flies at least 1 or 2 of the tranches? So the answer I have to that, Mike, is that had I known that they were going to be big swing days, that's what I would have done. I don't know what else to say. In hindsight, all of that makes sense. When you're actually putting the trade on and you don't expect it, and that's been really the problem. You've had these swing days that weren't expected. We expected things to go up. But most of these days have been like up, and then way down, or way down and then way up. It's just so weird. So I don't know how you expect that on any particular day. Swapnil asks, what made you decide then to do the longer term trade? Would we be doing those more often now? I didn't just decide this. This is something that I experimented with earlier on in the service, and it worked well. So the reason for it is that during these uncertain times when the market is kind of irrational, by putting on this longer term trade that can make a little bit of profit and buffer your account. So in other words, if we did nothing but this long term trade, I think that you could have a nice trading strategy, but you wouldn't make a lot of money. You'd make like 11, 12% over the year or something like that. But it would be kind of regular income. So that's what I'm proposing, that we increase our overall yearly total by 11, 12, 14% by putting on these very, very high probability trades that collect premium over a longer period of time to buffer those weeks where you might have a down week, and it just adds a little bit. So imagine just sort of getting the benefit of adding 10, 12% to your gains over the long term. That will tend to buffer things out. That's the idea. Hopefully that makes sense. All right, so let me get to the iron butterfly and some of the things that we can do with that. All right. The iron butterfly. Now, the iron butterfly is comprised of a put spread on this side and a call spread on this side, and they're both credit spreads. All right. So when we put it on, it's going to be a 1x1 and a 1x1, or where these two middle ones are short strikes, like that. Now, on an iron butterfly, both the short strikes, both of these, oh, that's a bad color. Both of those short strikes in the middle, these two, would be the same strike. But what we'll do is we'll spread them by one strike, maybe two strikes in some cases. So where a regular iron butterfly will look just like a butterfly, like this, by spreading the two strikes, it'll look more like this. Let me give a different color here. It'll look like that. So that'll be the difference. Now, let me show you some of the things that you can do with an iron butterfly that has this spread here. Now, for one, what this is going to do, now I guess I'm implying that it would be just as high here as it is on the regular butterfly. It wouldn't. It would probably be down to here. All right, that's probably a better representation of where it would be. It'd probably look more like that. All right. Now I'm going to go to a new chart. So let's say that we have our iron butterfly on. And let's say that price has moved up. Let's say that we started here and price has moved into our profit tent maybe all the way to here. Like that. Now, one of the things that we can do, I'm going to exemplify this a little bit. Hold on. I'm going to modify this a little bit so that we can get a better idea of what I'm talking about here. Just going to put it down further like that. Let's say it looks like that. Or let's even say that it's unbalanced or broken wing, right? And it looks like this. So let's say that it moves near to this call spread. One thing that you could do is this put spread here. I'm going to do the put spread in red. I'm going to overlay it with red. The put spread there, you can roll that closer this way by 1 or 2 strikes. Now what would that do? Well, here's the interesting thing. When that put spread moved, let's say that the profit's like this. When price moved to the right of that put spread, this spread was gaining that profit. Right? That's because if you looked at that put spread in isolation, if you were looking at it in isolation, its profit curve goes like this, right? And then of course the profit curve of the call spread goes like this, right? And then when you combine it, you get the other. But in any event, when price moves way over to here, it has used up most of the potential profit in that put spread. So what you can do is you can roll this put spread in the direction of price, like this, to turn it into an iron butterfly. And so that would look like this. I'll create a new chart. Let's say that the I'll draw the put spread and the call spread different colors. Now if price moved in this direction and maybe say got to here, what we could do is we could push this put spread or roll it. I'm going to use orange as the roll, and roll this put spread to here, or roll it all the way to here. What's going to happen then is you are going to lock in the profits that were made from this original put spread, and you're going to collect more premium on this new rolled put spread, which will in fact then take this, reduce the risk on your call spread up to here, because that profit that you locked in here will then appear here. I don't know if this makes sense to you or not. But by locking in that profit, you have now reduced the risk because you've already taken it in, you've won it. This is very similar to when we buy back our shorts. But now we're actually putting on a new spread that is now closer to the money, so it has more value and more credit. All right, some questions here. Given these big swing days, all right, we already did that one. What made you decide then to do longer term? I already did that. If the shorts are at different strikes, what makes it an iron condor and not an iron butterfly? All right, so that's a good question. What is the difference between a condor and a butterfly in like real life? you know, one is small and dainty, and the other one is big and gnarly, right? What's in between those two, right? If the small and dainty butterfly has grown up a little bit and gotten, maybe to the point of maybe a finch or a robin, maybe it's still like a butterfly, but it's now, or even like a hummingbird, I guess, but it has a little bit more breadth to it. But it's still not a condor, right? Condors are super wide, basically. They're just super wide. They're just completely different animals, to use the whole animal analogy. So you can call it whatever you want, right? The terms butterfly and condor, they do not explain or describe all the different variations of the spreads. All right. Robin asks, if the market gets to the call spread, why not just close the fly for profit? Does the max profit decrease? Well, that depends if how much profit that you have. Now, in the past couple of weeks, we've entered the profit tent, and the damn profit was depressed. It looked something like this. I'll let me put it on here. It's very frustrating, by the way. So we had some situations where we had, damn. And then the profit, you would think that it would start off like this, right? But it didn't. It when we got into the trade, it would do something like this. And so we couldn't even take the trade off even when we were inside the profit tent. It was like some sort of volatility crush that happened in the middle of the trade. Right? So there was really nothing that you could do. I don't understand why it did that. And this happened a lot to us. Happened on several trades. And I really don't get it. It made no sense. Does the max profit decrease? No. In fact, it increases a little bit. Mike says, will rolling the spread only be effective early in the day when there is still intrinsic value in the trade? No, it doesn't matter. As a matter of, because you'll be moving so far into the trade that you will have whatever, because the, here, I'll go back to it again. That original red put spread, its profit looks like this, right? So you're going up this curve. And so when you get to here, it's almost all depleted. It doesn't matter if it's at the beginning of the day or not. At the end of the day, it'll start filling this up more, like that. But still, you've achieved a lot of profit in that spread. And so you can take that off and roll it to a new credit. And that new credit will be, and this is sort of a misnomer, that new credit won't be down here. It'll look more like up here, and it will be higher up here. Be like that. Because it's closer to the money, these put spreads will be much more valuable. And so by doing that, when you combine it with the call spread, it will lift both of them. Does that make sense, Mike? Well, I'm going to assume then it does or it doesn't. I don't know if it makes sense to you or not. But when you put on these new spreads, they have more value than the old spread. So you locked in the old value that you collected, and you put on this new spread with more credit, and that when you combine it with the existing call spread, it lifts both of them. So that's the advantage of doing the roll. It's locking in profit that you've made, and it reduces your overall risk. So these are, now this isn't something that I expect to see happen a lot, right? But what it does is it gives you the ability to adjust, and it allows you to start with a higher probability of profit trade, and then extract more out of it as the price gets deeper into the trade. So how far would we move? Asks Jim. Well, first of all, Lance is saying, so rolling increases max profit and reduces risk. Does it push out the break even? I'm not really concerned about any break even. Does it push out the break even? No, because we're getting later and later in the day. The break even is constantly, getting closer and closer to the expiration. So that while it does push it out some, it's not significant, and you're not even in that case anyways. You're hopefully sitting in the middle of that profit tent, and that's what you're trying to manage. Jim asks, so how far would we move? Well, you can only move whatever the spread is on the short strikes of the iron fly. So if it's only one strike, you can only roll one strike. If it's two strikes, you could roll one or two strikes. You could decide. But, if by rolling those one or two strikes, you could pick up another $1 of credit, well, that reduces your risk by $1. So that's the idea. It adds more flexibility. This is not a trade I expect to put on a lot, but it gives you the ability to do that. So adjusting is not something that I see as like central to the strategy. However, putting on an iron fly that has greater probability of profit, I see as a positive move in these times where we're getting all of these trend intraday reversals and swings that are crazy. So, if you start off with a trade like this, now I've exaggerated it just to make a point. Let's say that this is 2 strikes wide, where before maybe it was like that, you've increased the probability of profit from, this extra distance here, this extra here and here. Now you've decreased the potential profit. However, what you're really after, though, is that this curve here, the effective distance of this curve, one versus the other, is not going to be a lot. So the effective difference in profit that you get when you're in the middle of the trade is not going to be a lot. It will be some, but it won't be a lot. It'll be more as you get closer to expiration, as this thing rises. That difference will be bigger. But in the beginning, it won't be as big. And if we are presented with the opportunity, and price does say get to the far side of this, we can achieve that greater profit by doing a roll. The other thing that the wider thing will do, now see, I don't want to make this too wide. See, what most of the other 0 DTE guys are doing is something very different. They're doing this. Oh, that's even bad. They're doing this. All right. We're going to do this. Two very different things. Their risk to reward is usually 1 to 10. Ours minimum is 1 to 5, but anywhere from 1 to 5 to 1 to 15. We'll still be able to get 1 to 5 with 1 or 2 strikes like that. Mike says, asks, we should expect the average debit to get into the trade to increase by 1 or 2. No. No, as a matter of fact, we'll have more flexibility, I think, to control that debit. And in fact, I don't think it will increase at all. And in some cases, it may decrease. We can put more risk on the far side because now it will be further away by another strike or 2. So that would, in fact, decrease the near side risk even more. So it's a small adjustment. It's not a huge adjustment, but it's enough that I think that will make a big difference. All right, how are we doing on time? Okay, we're about an hour into this. Let's see. I'll go back to... Did I lose my camera? Yeah, I lost my camera. Wonder what happened there. Oh, there I am. Yeah, I don't know what's going on with the camera, but it might go off again. Hopefully that has been clear, and I think this will work. I think what this will do is it will improve our probability of profit. And will it decrease our potential overall profitability potential? Maybe a little bit, but I think that by winning more trades, that will increase our overall profitability or our overall return. So that's and I think that it will help in this time where things are a bit uncertain, right? Where we have these swing days, and it's just a consequence of the times that we're in and the uncertainty that's going on in the market. So it's a small adjustment, but I think that that's the way to go. Where do you get the 1 to 5 numbers? That is the risk to reward, or the potential profit, which is the reward, or the size of the profit tent, and then the risk is the debit in the trade. Now, if you have a credit, there's very little risk. But if you have a debit on the near side spread, then that's your risk. Normally, our risk is about anywhere from $50 to $150, and our profit is usually 5 times to 15 times that, our potential profit. Lance asks, so what's the risk reward potential on the ironfly versus the butterfly? We're still going to shoot for the 1 to 5, so that won't change. That won't change. That's because we can adjust the near side risk to actually be better numbers, so we can put on these trades with even less risk than we're putting on now. So overall, I don't see that as changing. All right. Now, one could probably argue that it's changing by a matter of 5 or 10%, but we won't see it. And if you did a year-long study, that might be the end result. But in effect, you won't see that change day to day. I think the only change that you'll see is that it will be easier to make a profitable trade. Robin's asking, the ironfly will always be a credit, so how do you calculate the risk? It's still the debit. It's still the difference between the credit and the amount of premium that you collect, or the spread minus the premium you collect. It's all, it doesn't matter if it's a credit or a debit. It's all the same. I know that some traders are having a hard time with that concept, but there's no difference. Let me just put this back up and just show you. All right. So I have 2 trades. I have a debit, a butterfly, and an ironfly. They both look exactly the same. All right. So first I put up the butterfly. Whoop. And the butterfly looks like this. And then I put up the ironfly. And the ironfly looks like this. This one's a credit. This one's a debit. They both have exactly the same risk. All right? They're exactly the same. So whether they're a credit or a debit makes no difference. All right. All right, that's it. I don't know if anybody has any other questions, but go take a look at the analysis. I'm going to try to put on that trade that I described this evening. We'll see what happens when the market actually opens, and how, what kind of numbers that will give us, if they're any different than what I'm seeing right now. There probably is going to be a difference, but we'll see. And I think overall these changes will benefit us. And I don't want to go too far because I don't want to eat into the whole asymmetry part. The asymmetry is so darn important. We have to try to maintain that the best we can. It's always better to put on huge asymmetrical trades with tiny risk. If I can put on no risk at all, and the only risk that we have is the cost of the trade, the commissions, that would be cool. Because think of that. Let's say that we won only one out of every 6 trades, but our costs were maybe $20 per position, but the wins could be several $100s. We could easily do one 5 losses, 6 1 win, and still come out wildly profitable. Of course, that's not what I'm after. I'm after more wins than losses, but still have that asymmetry. Will you post your trade and fill on the Discord? So I created a new channel, Lance. First of all, I've always posted all my fills. Ever since I started the service, I've posted all my fills. The problem is that they were in the past, they were posted in the chat, in the talk channel, and then they got lost. So what I did now is I created a new channel called the Fills channel, and now all of my fills are posted there, so you can't miss it. And so those are things that have changed over time. For instance, I created a separate analysis channel for the same reason. My analysis was getting lost in the talk channel. So I created a separate analysis channel. So now there's an analysis channel. You see all the analysis. You can't miss it. Now there's a fills channel. You can't miss it. Now there's a suggest channel, which was, my trades that I was suggesting on top of the regular alerts. Now there's a suggest channel. Now everything is separated in its own separate channel. You can't miss it unless you're a dumbass. I don't suspect any of you are dumbasses. Or if you are, then those are the ones that I've had to exit from the service. There's been in the past 10 months, there's only been 2 dumbasses that I've had to eject out of 500 people. So that's a pretty good record, I think. All right. Any more questions? If there aren't, then I'll wrap everything up here and say thank you very much for joining me. Again, you can call me anytime you want. Everybody has my number. You can send me a note, an email. If you need some one-on-one time, if you're a member, then that's always available. I'm aiming to make this the best possible service for the money. I'm willing to lend my years as a professional trader, as a professional coach, and a mentor for what amounts to, in terms of what these types of services would normally cost, chicken feed. And I'm going to try to make it the best possible service for you guys. It's an effective strategy. I've made a lot of money on it over the last year. These past couple of weeks have been anomalies, and we'll get through them. And you follow this strategy, and over the long term, you're going to grow your account substantially. Right? Each person, their mileage will vary, right? Because it's not a systematic approach. It's a discretionary approach, and it really relies on your commitment to the strategy. There are some people that are in this group that are actually doing way better than me because they've taken the concepts and they've applied it on their own. They've come up with variations of it, and I'm just pleased as peaches. Yeah, those were my dogs. I have 2 Rhodesian Ridgebacks. There must be, I don't know, maybe a delivery guy or something. Okay, that's about it. I want to thank you very much. Please, if you have any comments, put them in the Discord. Questions, again, ask away, and we'll go from there. I hope you have a great rest of the day, and you have a good Martin Luther King Day. Or hopefully you have it off at work. If you're outside of the country, then I hope you have a great day, and Happy New Year to everybody. And peace. Peace to you all.